We've had an amazing recovery over the last few days, so much that the S&P 500 is almost green on the year. It's been an amazing recovery. We had a lot of fear in the market. The fear and greed index has reached 14 to 13. Now it went back up and it's around fear territory. But there was really a lot of fear, a lot of negative sentiment. I was doing some positive videos. A lot of you guys enjoyed them about why the market bottom is closer than you think. And there was a lot of hate around them. And I tried to tell you guys that the market bottoms on bad news. It bottoms when you least expect it to bottom. It bottoms when everything looks bad and the fundamentals don't look too good, because the market is forward looking and it prices in bad stuff before they start to affect the fundamentals. Like, this is a chart that shows you that prices bottom 9 months on average before earnings per share actually bottoms, because the market again is forward looking and it goes down in anticipation of those things potentially affecting the underlying company. Now, the real question is, was this really it? Was this really the stock market bottom? That we bottomed, we're going to make new highs? Or is this some kind of a fake out that's trapping everyone in and everyone's going to FOMO in? And after everybody deploys their entire cash position and they go on margin, then we go back down and make a new low? It's a hard question to answer, but I personally believe it's too early for anyone to be bragging that they called a stock market bottom. I'm seeing a lot of it on YouTube, a lot of it on X. There's a lot of overconfidence in the market. I think it's too early. Maybe after we make a new high, then you could say they called the bottom. But until then, I think we're not really safe. I think there's still a lot of negative catalysts that I want to talk about. The first one is mainly on the geopolitical front, with the United States not being able to reach a deal with Iran and Iran not wanting to stop their nuclear program and all kind of other demands. So again, there's a lot of bad things going on the geopolitical fronts, but I'm not a geopolitical expert and I don't pretend to be. So I don't like to comment on those events, but those could also be some events of concerns. Now, in terms of this market bottom, for me personally, it doesn't look really too good, because I would have preferred to see a broader participation from pretty much all the stocks, especially the speculative growth-related stocks. Normally, whenever you have a market bottom, everything tends to go up together, and the market doesn't give you enough time to pretty much buy any stock, especially the growth stocks. Now, if you look at this chart of the NASDAQ versus Robinhood and SoFi, especially Robinhood, because it's a broker, brokers correlate with the market, especially with crypto and retail sentiment. Robinhood and SoFi aren't really participating in this rally. You can go today and buy those stocks near their 52-week lows. This is not what happens in a market bottom. When we had a bottom in April and I bought Robinhood, it was up 15% on the same day. I barely had time to buy the stock around $31 to $32 per share. This is how a bottom looks like. You have a broader participation, and we haven't seen it yet. Something else that we haven't seen is the VIX reach 40. In most, market pullback, the VIX reaches 40, a little bit above 40, we bottom, and then we go back down. In this case, we got to 34. 34 is not bad. We had a few market bottoms around 34, but most of them happen above 40, and now the VIX is at 19. There's a lot of fuel for the VIX to potentially explode back to the upside. So if we went above 40, I would have felt a little bit more comfortable. We haven't gotten above 40 yet. Now, if you look at the chart of the S&P 500, we had a really bullish breakout above the 200-day moving average. A lot of you guys know I've been watching it. We had a higher high and higher low for 3 consecutive days. So this is a follow-through days and another 2 follow-through days. This is really bullish in general. But we have a massive gap on the S&P. Over 90% of the gaps tend to fill on the S&P 500. I would not be surprised if we go back down, potentially refill the gap, and then we see what happens with the market. So if we refill the gap and then we go much higher from there, then you could say this is a sustainable rally on a strong base, and this could have been the bottom. Now, we could refill the gap and go down and make a new low. I've seen them before. It happened before, and it could happen again. If you look at the history of those gaps, there were many cases where, people again believed that we're going to go up from here and everything's going to be fine. Then we went back down. At least we retested the 200-day. Normally we retest, we fill the gap, and then we go up and we start making new highs. So most of the gaps tend to fill, as you can see here also in general. But again, with the exception of this one, which hasn't filled recently, and then you have this one, which I don't know what's going to happen. But if I had to guess, I would guess unless there would be some kind of a negative catalyst that could cause us to at least retest the 200-day or at least refill the gap. I think it would be a good time to potentially add a little bit more to the market. Now, there's also other catalysts that I'm watching. One of them is the CPI. The CPI came at 3.3 versus 3.4% expected. Now, that doesn't sound too bad on the surface, but if you look at the month-over-month increase, it was the largest increase we had pretty much since early 2023. So that was a massive, massive increase, largely driven by energy, where energy soared about 12%. Energy is actually up much more than 12%, but the government doesn't use actual energy numbers. They manipulate them with surveys and all kind of things, where they always get the lowest number. Same thing with shelters. They don't use actual rent prices. They use something called owner's equivalent rent, where they ask people, I think, what kind of rent do you expect to pay in the future or whatever, and they base the increase based on it. But rents were up much, much more, but the shelter was showing like 2 or 3%. So again, a lot of it is pretty much not honest, it's manipulated, but still energy drove a massive increase to the CPI at 9% months over month, 0.9%, and that's really, really bad. Now, the good part is energy is not expected to remain at $96 or $80 per barrel forever. The future curves is telling us that traders are betting on energy or crude oil going back to the $70 range, a little bit under 70 actually, by December of 2027, or even December 2026 is expected, $74, $75 per barrel. So it's really not bad at all. It's not expected to stay here. So it's really up to the Fed chairman to determine monetary policy. I think if it was Jerome Powell, he would not be willing to cut interest rates in a rising CPI environment because he has recency bias from the word transitory in 2021. Now we have Kevin Warsh coming in. Kevin Warsh is more open to making monetary policy decisions based on longer-term impacts of deflationary pressures from AI instead of shorter-term impacts. So if it was Kevin Warsh, I think he would be willing to cut interest rates into a rising CPI because it's driven by a one-time event, which is an increase in energy based on a one-time kind of war. And I think that's what would likely happen, but we still don't know if he's going to get confirmed or when he's going to get confirmed. Until then, Jerome Powell will remain the chairman of the Federal Reserve. Now, something else that I'm watching is a 10-year minus 3 months, which is, you could say, a recession-related indicator. Every time the yield curve goes negative and it re-inverts, you have the gray shaded area, which is pretty much a recession. We went back there and now we're re-inverting. And that's pretty much telling us that we could potentially have a recession or a really bad event happening. It happened before 2008, before 1999, before 1990, 1991, and it pretty much has a 100% success rate. It never went below and went above, and we didn't have a recession. Even before COVID, it kind of happened. So it will be interesting to see what happens over here. And the same thing, with as a Fed funds rate. When the Fed funds rate increases so much and they start to reduce the fund rate, they normally do it into a recession. You could see it in the gray shaded area. It goes into recession. Now, the reason for that is because whenever the Fed is hiking interest rates and is tightening the balance sheet, they're removing liquidity from the system, which could lead something systematically to potentially happen. And it has happened almost every single time, where whenever the Fed hikes interest rates and they start to cut, we tend to have something very, very bad happening. It could be anywhere. It could be also in private credit. I believe private credit is overblown, but we're having a lot of redemption requests. A lot of them are limited by a quarterly max redemption. But if we have more and more and more redemptions, it's kind of like a bank run, which could lead some bad things to happen. Even though some of the credit stuff is good, but lower liquidity within those institutions could also lead some kind of a potential systemic event. So I personally believe there's a good chance that the market bottomed and we're going to shrug off the bad news and make new highs. It's very possible. But I think it's too early to brag that the worst is behind us and everything's going to be fine from here. We still have a lot of, you could say, potential things that could happen. We could have the geopolitical stuff escalate. So my base case on the S&P is we at least retest the 200-day moving average, refill the gap a little bit. Then we see what happens. If we retest the 200-day and we start going up from there, then you could say maybe this is a stock market bottom, especially if we make a new high. If that doesn't happen, we refill the gap and we could potentially then go lower, then it wasn't a market bottom. So I'm not trying to time the market, but my base case is we kind of get back to the 200-day day, see what happens. I think it's too early to be confident that someone has timed the market bottom. And that's my opinion on the market. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.